Market update, Thursday, 18th of June. Very important day for markets yesterday. It was the first meeting from the Federal Reserve under Kevin Warsh, who appeared quite hawkish, contrary to market expectations, because the reputation he had built before taking the job, it was more of a dovish tone. In other simple terms, more of a accommodative tone, looking for sort of rate cuts and things like that. But during this meeting, he appeared, in terms of communication, he appeared a bit cagey in my view. Markets were looking for some signals, some hints about the framework, about the set of tools he is going to deploy to bring this inflation or to curb this inflation. But he didn't reveal much. So this was the major shift from Jerome Powell. Kevin appeared much more reserved in terms of his communication. And I think, as I mentioned before, part of the reason he's trying to sort of reverse or change his perception, which he has sort of accumulated over the years. As a result, bonds, treasuries, 2 years, the short dated, sold off aggressively. So did the tech stocks. Why bonds, treasuries, govies, short dated, sold off? Because they are the most susceptible, most vulnerable to short-term interest rate movements. And when yields rise, which means bonds sell off, prices fall, it has a direct impact on tech stocks, because we use treasury yields to discount tech earnings, growth stocks earnings back to the present. And we saw what happened yesterday. Despite the signing of the deal, despite the signing of the memorandum of understanding between Iran and the US, the inflation concerns, as I have been repeating over the last few days, they are very much there. Markets seem more worried about inflation now than they have ever before. Expectations for rate hikes have actually gone up slightly based on CME's expectations, projections. So going forward, I think it's just it's worth bearing these sort of things in mind. Bank of England and the Bank of England is also deciding on the rates later today. I'm not expecting any changes because our inflation came out at 2.8% versus an expectation for 3% yesterday. So which is a welcome news, which lowers the pressure on the Bank of England to raise rates, because inflation seems to be coming down anyway. And with the situation in the Middle East, hopefully, things are likely to improve. Gold tends to benefit from this sort of situation when there's an expectation for rate cuts, or an expectation or lower expectation for rate hikes. So the sooner this situation resolves, which it seems to be progressing very quickly, they have even signed the documents electronically, US and Iran, even before tomorrow's meeting in Geneva. So the sooner this situation resolves, the better it is for financial markets. Because if you remember, on the 28th of February, the day before Iran was attacked, we were expecting 2 rate cuts in the UK, 2 rate cuts in the US. 1 week into the war, we were expecting 2 hikes in both countries. As things currently stand, the oil prices have fallen aggressively, and we know the reasons for that. So it's worth sort of keeping these sort of factors into account. But I'm expecting a lot more volatility over the coming 2 weeks, partly due to the 2 new IPOs towards the end of this month. So as always, stay diversified. If you have any questions, drop them in the comments and I'll get back to you. And this channel is, as always say, none of this is financial advice. This is very much all educational for general information purposes. If there's anything you can't get your head around, if there's anything which is bothering you about markets, any technicalities, any jargons you can't really quite understand, drop them in the comments and I'll come back to you. All the best. Cheers.